All the ICT concepts simplified in one single video. We will follow in order from the most basic to the most advanced concepts. Pay close attention, and let's jump into it. The first concept is swing levels. They are the most basic trading concept we need to understand before getting into more complex ICT concepts. There are two types of swing levels: swing highs and swing lows. To identify swing levels, we need sequence of multiple candles, usually 3 or more candles. In a swing high situation, the candle in the center has a lower high to the left and a lower high to the right. In a swing low, the candle in the center has a higher low to the left and a higher low to the right. The reason the swing levels are a very important basic concept is because most retail traders place their stop losses just above swing highs or just below swing lows, indicating that the market is getting fueled by liquidity pools in those areas. Keep in mind that in a buy-long trade, the stop loss and the take profit targets are both sell orders, because obviously a buy order is closed by a seller order. And in a sell-short trade, the stop loss and take profit targets are buy orders. Since a buy order is closed by a sell order, this knowledge leads us to the concept of buy-side liquidity and sell-side liquidity. Right above a swing high, there are a large number of stop orders from short trades, which are buy stop orders, and there are also a lot of buy stop orders from traders that intend to go buy long if price breaks the swing high. In ICT concepts, this level represents buy-side liquidity. Right below a swing low, there are a large number of stop loss orders from buy long trades, which are sell stop orders. And there are also a lot of sell stop orders from traders that want to place sell short orders if price breaks the swing low. In ICT concepts, this level represents sell-side liquidity. The identification of buy-side liquidity and sell-side liquidity levels is very important in market analysis and trade entry models. These basic fundamentals are used directly and indirectly in all ICT concepts, so make sure to master them. Now let's jump into the charts to observe examples of buy-side liquidity and sell-side liquidity. The GBP against the US dollar pair on the 30-minute time frame. The market initially has set an uptrend with significant upside candles, without even pulling back, so there was a large increase in bullish momentum. Usually when the market moves that aggressive into one way, it tends to pull back because market chases constant efficiency and balance. The pullback has been set, which is what we see after making the local high. Now that we did the basic analysis, we can find the buy-side liquidity here, which is the highest point, and the sell-side liquidity right here, which is the lowest swing point since the trend has been set. It first broke the sell-side liquidity, and it instantly reverted to the upside. This is the type of movement we see in so-called liquidity sweeps. And the whole point of taking liquidity is for smart money to use the stop losses from the masses of traders to open their large-sized orders. This theory is even more validated because we initially were in an uptrend, so the point was to liquidate stop losses and continue the main high time frame trend. In this case, if we first broke the buy-side liquidity, we would not consider it as a liquidity sweep because it did not align with the main trend. And soon after, the market went towards the buy-side liquidity. As a quick recap, if price first breaks the sell-side liquidity on a high time frame uptrend, look for buy-long setups to take price towards buy-side liquidity. And if price breaks the buy-side liquidity in a downtrend, look for sell-short setups to take price towards the sell-side liquidity. Equal highs and equal lows, and as well as previous highs and previous lows. In this chart, we can see an example of equal highs. Notice how multiple swing highs are positioned together almost or exactly in the same level. Still in the same chart, we can observe an example of equal lows. In this case, the multiple swing lows are positioned together to form equal lows. It's very important to notice that equal highs and equal lows don't necessarily happen in the same price level perfectly. Most of the times they do, but there are exceptions to the rule. The exceptions are when there is formed smart money structure like a demand, a supply, or order blocks. We are going to talk about it later. One of the most used concepts in the ICT and smart money community is fair value gap. The fair value gap is a 3-candle sequence that prints an inefficiency between the price. A gap is formed between the first candle and the third candle. Let's first take a look at the bullish fair value gap. The bullish fair value gap is a pattern where the upper wick of the first candle doesn't overlap with the lower wick of the third candle, creating a gap between the two. Let's quickly compare price action movements where we can identify a fair value gap and one where we cannot. On the left, we can see that there is no overlap between the upper wick of the first candle and the lower wick of the third candle. Therefore, it leaves a fair value gap. On the right, we can see that the upper wick of the first candle overlaps with the lower wick of the third candle. In this case, we do not have a fair value gap. The bearish fair value gap is situated where the lower wick of the first candle doesn't overlap with the upper wick of the third candle, creating a gap between the two. Let's quickly compare between three candle patterns, where we can find a fair value gap, and one where we cannot. On the left, we can see that there is no overlap between the lower wick of the first candle and the upper wick of the third candle. Therefore, it leaves a fair value gap. On the right, we can see that the lower wick of the first candle overlaps with the upper wick of the third candle. In this case, we do not have a fair value gap. Now that we know what are fair value gaps and how to identify them, we need to know what they are used for. Fair value gaps are a way of market to rebalance after an inefficiency has been created. So fair value gaps are entry models for a low time frame rejection and continuation of the main trend. A bullish fair value gap is mitigated when the price pulls back down and hits the gap area, and rejects to the upside, continuing its bullish main trend. In this case, the bullish fair value gap is an entry opportunity for buying positions, and the opposite works for the bearish fair value gap. When a bearish fair value gap has been printed, if the price comes back up into the gap zone, the price looks to reject to the down, continuing its main bearish trend. In this case, the bearish fair value gap is an entry opportunity for selling positions. This is an example of a bullish fair value gap on a charting setup, where we first have an efficient price action on the left. Notice the impact of the wicks. Then it manages to sweep the liquidity of lows and instantly shot the price up afterwards. This push to the upside confirmed the uptrend by creating a new bullish break of structure. And even more important to know, it validated the following fair value gap, where we can see, just like we explained before, the high wick of the first candle with the low wick of the third candle. It's a valid bullish fair value gap, and the setup to it was the buy-long entry that has been opened by the fourth candle. Stop loss below the fair value gap zone. Take profit to at least a 1-to-2 risk to reward ratio or above a structural high in the high time frame. And this is charting setup example for a bearish fair value gap. We can easily see on the left of the chart that this market was following a downtrend, so looking for bullish fair value gaps make no sense, so they are instantly invalidated since we need to ride the trend instead of trading against it. We can notice a bearish fair value gap formation from the lower wick of the first candle to the higher wick of the third candle. The entry setup for the sell short is opened at the fourth candle. The stop loss above the fair value gap zone. The take profit below the equal lows that gathered the liquidity from the past moves, which we can see that it targeted those equal lows to break them. There are multiple ways of using order blocks. Let's separate the two main ways into large body candles, which are mostly referred to as high probability order blocks, and small body candles with larger or longer candle wicks, which are mostly known to be lower probability order blocks. First, let's learn about the high probability order block, which is the most important one. The bullish variation of an order block is formed by the large body bearish candle, or the sequence of large body bearish candles that sweep sell side liquidity, and then lead to a break of a previous high right after it, which in this case is called a break of structure. The order block is met at the open of the large body bearish candle that sweeps sell side liquidity. Price action often pulls back to the order block before moving higher. The bearish variation of an order block is created by the large body bullish candle, or sequence of multiple large body bullish candles, that sweep buy-side liquidity and then lead to a break of a previous low shortly after, which in this case is called break of structure. The order block is created at the open of the large body bullish candle that sweeps buy-side liquidity. Price often looks to pull back to the order block before moving lower. Notice that high probability order blocks come from interesting formations, where a lower low is followed by a higher high in the scenario of a bullish order block, or when a higher high is followed by a lower low in the scenario of a bearish order block. Let's jump into a chart example of a high probability order block and implement it into a simple trade strategy. On the GBP against the US dollar, the 4-hour time frame has been standing bullish with an increasing momentum. After setting a local high, the market pulled back, but changed character by breaking the last swing low. So this is an important signal that this market is soon to reverse into a downtrend. In a downtrend, we look for bearish order blocks to be respected instead of the bullish order blocks. And shortly after, we got one bearish order blocks validated by price constantly breaking lows, so making lower lows and lower highs, placing a sell short at the touch of the order block zone. Stop loss right above the zone. Take profit below the current low, since we are expecting a new lower low of this downtrend. And it's this simple. Order blocks are one of the most effective and easy setups. And this is the gold against the US dollar on the 4-hour time frame. Similarly, like the last example, the market was initially in an increasing momentum and aggressive uptrend, described by simple higher highs and higher lows formations. But in this situation, the uptrend continues, and it is confirmed by a bullish break of structure of the last swing high. This confirmation validates this bullish order block. Keep in mind that we are looking for bullish order blocks only if the trend is bullish. So we are just riding the trend. Buy long at the touch of the zone. Stop loss below the zone. Take profit above the last swing high, expecting to create a new higher high, therefore a new bullish break of structure. The order just got triggered at this level. And that's it. The next one is the silver bullet strategy. This is a scalping strategy, therefore it should be traded in the 1-minute time frame, 5-minute time frame, or 15-minute time frame. The silver bullet must meet the following requirements to become a maximum validity setup. The first requirement is the least important one, and it's about marking the price between the upcoming New York session. The New York sessions opens at 9:30 a.m., and the most volume traded, therefore the most manipulation done, is met in the first 1 to 2 hours of the session open. So we want to mark the end of the silver bullet area at about 11 a.m. Keep in mind this is New York time zone that is also called the EST or EDT. After we mark the zone successfully, we need to identify the swing liquidity levels from both sides, the buy side liquidity and as well as the sell side liquidity. And we look for the price to break one liquidity level in the silver bullet zone inside the New York session. The point of the silver bullet strategy is that the first break is a manipulation to take the market in the opposite direction of the break. So what we are looking for is for price to come back up, in case that the lower liquidity level has been taken, or for the price to go down in case the higher liquidity has been taken. Right after the break and move back inside the zone, we look for a fair value gap. Usually there is one, and we take price all the way to the opposite swing liquidity level. SMT divergence, or so-called the smart money divergence, is a concept that indicates divergence swing levels of correlated pairs. The most used pairs for the SMT are NQ with ES and Euro USD with GBP USD. The SMT divergence is caused when one pair, let's say the first one is the NQ futures, makes a lower low, but the ES futures does not make a lower low and instead makes a higher low. This happens exactly at the same time, so the two swing levels between pairs are diverging. This can signal that the lower low made on NQ has high chances of being a liquidity sweep to take the price higher afterwards, basically converging or correlating back with the ES. So we would look for buying opportunities and setups on the NQ. This is even more validated if the ES creates a bullish change of character and follows the reversal into the uptrend. But it doesn't have to happen at all times, so it's not really necessary. The turtle soup. This concept is met when the current price consolidates between a range. While having important external levels, they could be points of interest like an external buy-side liquidity and external sell-side liquidity. At the same time, The ranging price action itself has internal buy-side liquidity and internal sell-side liquidity. This is the structure of the turtle soup. The main action comes when price breaks one internal liquidity level. Let's say it breaks the internal sell-side liquidity. This break is called the turtle soup. It is defined by the first internal break being a liquidity sweep, so a fake move to take price to the opposite way. This is even more supported if we have an external entry structure like a demand, order block, or fair value gap for price to reject to the upside from it. So this causes the external price structure to go up, and we can look for an internal fair value gap or bullish order block for buying setups to take the price up into the external buy-side liquidity. And for the bearish scenario, the market looks to first break the internal buy-side liquidity. Then we do the same process, finding sell-short setups to take the price down towards the external sell-side liquidity. Here we can spot a ranging market after an upside has been faded down. In this range, we got the buy-side liquidity and the sell-side liquidity. The sell-side liquidity has already been broken down, so our target would be to hit the external buy-side liquidity, which are towards the local swing highs. The entry could have been on this small fair value gap, and the price stopped towards the external buy-side liquidity because it has hit a bearish order block from the zone. So, the most likely scenario after this push to the upside is for the market to now trap the buyers after first tricking the sellers. The ICT power of 3 concept. First, we'll look at price action models and then some real chart examples. The ICT power of 3 is a concept that follows accumulation, manipulation, and distribution for the bearish power of 3 price opens up of the session start. This is where you usually see the accumulation near the opening price, then it will make a local high. The high is the manipulation, so you will likely see some accumulation where price is moving upside and downside with volatile and indecisive price action on a lower time frame. Then it will finally make the local high. This is the manipulation for smart money to sell to the buy stops from above. Then price looks to distribute down, in case you do not understand what distribution means. Within this bearish power of 3, we are looking for manipulation above the opening price to make a high. In this price leg that makes the high up here, we are looking to position ourselves and look for setup opportunities because we are looking to sell above the opening price and then hold towards the close of the session. So you see accumulation near the open, manipulation which makes the high, and then price makes a low and then closes. We're looking to hold towards that close, not right at it because that it's impossible to predict. And the other way around can also be done. In that case, that would be a bullish power of 3. The accumulation now first breaks to the downside, which is the manipulation. Then we look for setups to take the price up into the close with buy orders. So the distribution is met to the upside. Now let's see how it looks on a charting backtest. Right here we can see the accumulation defined by a ranging market. The accumulation ends by breaking down, which means that the manipulation was towards sell-side liquidity. If what we learned is valid, the distribution should be to the upside to break up the highest point of the accumulation. We have a fair value gap as an entry support model, placing the entry on the touch of the zone, stop loss below it, and take profit above the high of the accumulation. And that was the distribution towards the close, just like in the model that presented before. If you're looking to get funded, check the link in the description, where we go into depth on how to use these concepts to pass prop firm accounts. If you found the video helpful, leave a like and subscribe, and see you in the next one.